If I told you that the market never decides when you scale, you do, and most traders quietly say no without realizing it, you'd probably feel a pause in your chest right now. Jesse Livermore did. He discovered that long before charts were digital, before indicators were packaged, before trading became fast and loud, he learned it the hard way, through cycles of fortune and ruin, and this single realization explains why so many traders can make money, but almost none can hold it. Before we go any further, if you care about trading psychology, timeless market wisdom, and the mental edge that actually separates professionals from everyone else, take a second to subscribe, like this video, share it with another trader, and comment where you're watching from and what time it is right now. That small action helps this message reach traders who are stuck at the same ceiling you might recognize in yourself. Livermore noticed something early in his career that most traders never articulate. He could trade well with small size. His reads were sharp. His timing was clean. His patience was intact. But the moment his position size increased, something subtle shifted. His exits came sooner. His losses felt heavier. His attention narrowed. The market didn't change. He did. That was the moment Livermore realized scaling is not a technical problem. It's a psychological one. This is what we mean by psychological permission. Every trader has an internal regulator, a nervous system-based threshold that determines how much uncertainty, exposure, and consequence they can tolerate while remaining rational. When your account grows beyond that threshold, your mind intervenes. Not consciously, automatically. It will find a way to bring you back to familiar emotional territory, sometimes through mistakes, sometimes through overtrading, sometimes through bad luck. But the result is the same. You shrink back to where you feel safe. Most traders misinterpret this. They think they need more confidence. Livermore learned that confidence is not a prerequisite for scale. It is a result of surviving scale correctly. Permission comes first, confidence comes later. This is why traders often sabotage winning streaks. They don't trust the expansion. Their identity hasn't caught up to their equity curve. The account grows faster than the self-image, and that mismatch creates tension. Livermore understood that money doesn't just buy opportunity, it demands psychological capacity. If the capacity isn't there, the system corrects violently. He also realized something uncomfortable. The mind is far more comfortable losing money than becoming someone new. Scaling capital forces an identity shift. You are no longer the trader who hopes. You become the trader who manages consequence, and that responsibility terrifies most people. So they unconsciously reject it. They give profits back. They break rules. They chase noise. Anything to return to the quiet, old, familiar, emotional equilibrium. Livermore refused to let this happen unnoticed. He began observing himself the way he observed price. Not judgmentally, not emotionally, objectively. He noticed when size caused tension. He noticed when his breathing changed. He noticed when he checked P&L instead of structure. These were not failures. They were signals. Signals that his psychological permission had not yet expanded to match the exposure, so instead of forcing scale, he trained for it. Livermore increased size only when his behavior remained unchanged, not when he felt excited, not when he felt confident, only when his execution stayed calm, patient, and consistent. The moment his behavior deteriorated, he reduced size without argument. No ego, no rationalization. That discipline is rare, and it's why he survived long enough to scale again and again. Most traders do the opposite. They increase size to feel confident. They believe bigger profits will silence doubt. Livermore learned that bigger size amplifies whatever already exists. If fear is present, it becomes louder. If impatience is present, it becomes costly. Size does not fix psychology. It exposes it. This is why psychological permission cannot be faked. You don't grant permission by saying, "I'm ready." You grant permission by proving, through repeated exposure, that you can remain disciplined under pressure. Livermore treated scaling like weight training. You don't jump from lifting light to lifting heavy because you want to look strong. You progress only when your form holds under load. The market works the same way. Another insight Livermore uncovered was that calm, not excitement, is the signal of readiness. When traders imagine scaling, they imagine adrenaline, intensity, and thrill. Livermore learned that true readiness feels almost boring, when size no longer creates urgency, when P&L fluctuations don't hijack attention, when decisions feel procedural rather than emotional. That's permission. Anything else is premature. This is where boredom enters the conversation, and most traders recoil. Livermore accepted boredom as the cost of growth. He understood that emotional stimulation is addictive and deadly at scale. The trader who needs excitement cannot hold large positions without interference. So Livermore trained himself to sit, to wait, to do nothing when nothing was required. That ability, to remain neutral while exposed, is what allowed capital to expand safely. It's also why so many traders plateau forever. They mistake emotional intensity for engagement. They believe being locked in means being stimulated. Livermore knew better. Being locked in meant being unmoved, detached, clear, responsive, not reactive. There is a painful truth hidden here. Many traders say they want more money, but they do not want the emotional stillness that comes with handling it responsibly. They want the reward without the internal reorganization. The market never allows that trade. Livermore also learned that permission is not permanent. It must be maintained. Fatigue, life stress, overconfidence, all can shrink capacity temporarily. When that happened, he scaled down, not as punishment, but as alignment. He respected the current version of himself rather than demanding performance from a version that wasn't present. This self-honesty is what most traders avoid. They push when they should pause. They force when they should wait. Livermore listened instead. So if you've ever felt like you know how to trade but can't seem to grow beyond a certain level, this is not a flaw. It's a signal. Your strategy may be ready. Your psychology may not be. And that's not a dead end. It's a direction. Before we move on, like this video, subscribe to the channel, share it with another trader, and comment below where you're watching from and what time it is right now. What comes next builds directly on this foundation, and without understanding permission, nothing else works. Once Livermore understood psychological permission, he began to notice something even more precise and far more dangerous. Permission alone wasn't enough. Even after expanding his tolerance for size, there were moments when his execution would subtly degrade. Not always dramatically, not in obvious ways, but just enough to cap his growth. That's when he discovered emotional ceilings. An emotional ceiling is not fear in the traditional sense. It's not panic. It's not hesitation. It's the quiet point where the mind stops processing information cleanly and starts seeking relief. Relief from uncertainty. Relief from exposure. Relief from responsibility. And the market, without mercy, finds that point again and again. Livermore realized that markets don't break traders by surprise. They break them by pressure. Sustained pressure. Pressure that doesn't look dangerous at first. Pressure that accumulates invisibly. Internal volatility, he learned, was far more destructive than market volatility. A calm trader could navigate violent price swings. A volatile trader could destroy himself in a slow, orderly market. This reversed how Livermore evaluated risk. He stopped asking, "How volatile is the market?" and started asking, "How volatile am I?" That question alone puts most traders on edge, because it removes the illusion that risk lives outside of them. Livermore noticed patterns. After a series of wins, his thinking became looser. He took marginal trades. He listened less. His emotional ceiling actually lowered after success, even though his confidence rose. After losses, something different happened. His focus sharpened, his selectivity improved, his discipline increased. The danger was never losing, it was imbalance. Most traders believe wins stabilize them and losses destabilize them. Livermore learned the opposite. Wins distort, losses clarify, but clarity fades quickly if not respected. So he built a system around emotional volatility, not to eliminate it, but to contain it. He kept his routines identical regardless of account size or recent performance. Same preparation, same risk framework, same patience. He refused to let recent outcomes influence present decisions. This consistency of behavior became his anchor. Most traders anchor to results. Livermore anchored to process. He also learned to spot the early symptoms of emotional overload. They weren't dramatic. They showed up as urgency, as fixation on P&L, as the need to be right now, as irritation with the market for not moving fast enough. These were not signs of opportunity. They were warnings. When those signals appeared, Livermore reduced exposure, not because the market had changed, but because he had. This is where many traders fall into denial. They see reducing size as weakness, as fear, as regression. Livermore saw it as intelligence. He understood that size is a privilege, not a right, and privileges are conditional. The market does not punish traders for reducing risk. It punishes them for refusing to. Internal volatility also changes how time is perceived. When emotional load is high, traders shrink their time horizon. Every tick feels important. Every fluctuation feels personal. Livermore recognized this distortion and trained against it. He deliberately thought in longer frames when size increased, not because the market required it, but because his mind did. Stretching time reduces emotional amplitude. It reintroduces context. It restores perspective. Scaling capital required this expansion of mental time just as much as it required financial growth. Another insight Livermore uncovered was that emotional ceilings are not fixed. They move. Sleep, health, stress, ego, boredom, all shift capacity. This is why rigid position sizing rules often fail. They ignore the human variable. Livermore didn't abandon structure, but he adapted it dynamically. When his internal state was stable, he allowed size to expand. When it wasn't, he contracted without negotiation. No internal debate, no justification. That decisiveness protected him more than any stop-loss ever could. This is where most traders confuse discipline with rigidity. Livermore understood discipline as responsiveness. Rigidity breaks under pressure. Responsiveness adapts. He also stopped trying to feel good while trading. Emotional neutrality became the goal. Not happiness, not excitement, just clarity. He accepted that discomfort would always be present at the edges of growth. The difference was that discomfort no longer controlled him. Traders who chase emotional comfort never scale. Traders who tolerate emotional discomfort but don't obey it do. And here is the uncomfortable truth. Internal volatility is contagious. One impulsive decision creates emotional residue. That residue influences the next decision, then the next. Livermore learned to break this chain early. The moment he sensed emotional contamination, he stepped away. He protected his future decisions by honoring the present signal. Most traders try to trade through emotional turbulence. Livermore stepped aside until clarity returned. That restraint saved his capital again and again. If you've ever wondered why you trade well for weeks and then suddenly unravel, this is why. You didn't lose skill. You crossed an emotional ceiling and didn't recognize it. The market didn't change. You did. And that realization is empowering. Because ceilings can be raised, volatility can be managed, but only if it's acknowledged. Once Livermore understood his emotional ceilings, his entire approach to the market began to change, not by becoming more complex, but by becoming more selective. He realized that scaling capital was not about increasing activity. It was about increasing precision. The larger the size, the fewer decisions you can afford to get wrong. Not because the market becomes unforgiving, but because your own psychology does. This is where most traders collide with boredom and misinterpret it as stagnation. Livermore learned that the market offers thousands of opportunities, but only a handful are worth serious capital. Everything else is noise, and noise becomes dangerous at scale. Small size can survive noise, large size cannot. So he began eliminating trades, not because they failed statistically, but because they were emotionally inefficient. Every trade costs attention. Every decision drains clarity. Livermore understood that attention, like capital, must be conserved. The trader who spends emotional energy on marginal setups will not have the capacity to act decisively when the real opportunity appears. This is why he stopped trading constantly. He waited. He watched. He did nothing far more often than he acted. To most traders, this feels unbearable. Platforms are built to encourage action. Content is built to glorify activity. Livermore rejected both. He knew that boredom was not the enemy. It was the filter. Only traders who can endure inactivity without forcing trades are capable of scaling safely. Selectivity also reshaped how he viewed risk. He no longer spread risk across many ideas. He concentrated risk into clarity. When conditions aligned, trend, structure, sentiment, and his own internal state, he committed. When they didn't, he withdrew completely. Half commitment was more dangerous than full commitment. It created hesitation. Timing became inseparable from patience. Livermore understood that being early feels exactly like being wrong, and large size amplifies that discomfort until the trader interferes. So he stopped trying to predict. He waited for the market to confirm, not because confirmation removed risk, but because it removed hope. Hope is the most expensive emotion in trading. Each addition of size was earned. The market had to prove him right before he agreed further. This removed ego from the process. He wasn't asserting dominance. He was responding to evidence. Modern traders often misunderstand this. They think pyramiding is aggression. Livermore used it as validation. Each add-on was a declaration of alignment, not conviction. He never argued with the market. He listened and responded. Restraint didn't end after entry. This is where most traders fail. Once in a trade, Livermore resisted the urge to manage every fluctuation. Micromanagement, he learned, was a sign of distrust, either in the setup or in himself. He trusted preparation over sensation. Once positioned correctly, his job was to stay out of the way. Large size magnifies emotional interference. Every tick invites reaction. Livermore trained himself to ignore the noise by anchoring to structure. As long as the market behaved according to its underlying logic, he remained still. Movement alone meant nothing. This ability, to sit while exposed, is one of the rarest skills in trading. Restraint also defined his exits. He did not take profits because he felt afraid. He exited when conditions changed, when structure broke, when the market told him the reason for the trade no longer existed. This allowed winners to grow beyond what felt comfortable. Most traders take profits when they feel good. Livermore took profits when the market stopped being good. Scaling capital requires this obedience. The market decides how much you make. The trader's role is to avoid interrupting that decision with fear or impatience. Another layer of restraint appeared in how Livermore handled information. As his size grew, he consumed less opinion, not more. Noise multiplies at scale. News, forecasts, other traders, all become distractions. Livermore learned to go quiet when the world got loud. He trusted his preparation more than consensus. Independence of thought became non-negotiable. This is the irony of scale. The more successful you become, the more tempting it is to listen outward instead of inward. Livermore saw this temptation clearly and paid for it when he ignored it. Each time he drifted from selectivity and restraint, the market corrected him swiftly. Restraint is not passivity. It is controlled aggression. It is waiting without suffering, acting without force, withdrawing without regret. Most traders believe discipline is about following rules. Livermore understood it was about refusing temptation. Temptation to trade when bored, temptation to add when uncertain, temptation to exit when uncomfortable. Every time he resisted temptation, his capacity to scale increased. And here is the paradox. By trading less, he made more. Not because fewer trades are magically better, but because his best decisions received his full attention and emotional clarity. If you feel like you're always busy but rarely growing, this is why. Activity is not progress. Precision is. Before we move on, like this video, subscribe, share it with another trader, and comment where you're watching from and what time it is right now. The next section is where many traders lose everything, not because they don't know what to do, but because success changes them. The market has a way of teaching humility, and Livermore learned this lesson repeatedly. After periods of significant wins, he noticed a subtle shift inside himself. Confidence, once his ally, began to mutate into entitlement. Rules felt flexible. Caution seemed unnecessary. That quiet ego creep, so invisible, so seductive, is where many traders fall hardest. The market doesn't need you to be overconfident. It simply responds to the opportunities you create for yourself when ego overpowers discipline. Livermore realized early that his largest drawdowns did not come from missing trades. They came from the aftermath of success. Winning made him more aggressive, more impulsive, less attuned to his internal limits. This is the paradox of scale. Your best periods are the most dangerous. Momentum feels like certainty, but the market rewards alignment, not arrogance. To survive this, Livermore developed what he called deliberate contraction. After major wins, he intentionally reduced position size, not as a punishment or out of fear, but as a tool to recalibrate his psychology. He slowed down. He observed the market instead of chasing it. He allowed his internal state to reset. Contraction, he discovered, was just as important as expansion, arguably more so because it maintained longevity. Most traders resist contraction because it feels like regression. Stopping after success seems unnatural. Livermore saw it differently. Scaling is not a straight line. It breathes. Expansion without contraction leads to collapse. Ego hates this truth, yet mastery depends on embracing it. He also relearned the lesson that public visibility amplifies temptation. The more he succeeded, the louder the noise around him. Traders, commentators, and the press all offered opinions, most of them irrelevant or misleading. Livermore withdrew, trusting only his preparation. The market doesn't reward reputation. It punishes complacency. Stepping back after success preserved not just capital, but mental clarity. Ego, he realized, is not eliminated. It is managed. After every significant gain, he imposed artificial limits. He reduced size, avoided new trades, and spent time recalibrating. This ensured that emotional momentum, whether from fear, greed, or overconfidence, did not dictate actions. He knew that unchecked ego amplifies every mistake at scale. The lessons here are counterintuitive but essential. Success, when mishandled, breeds vulnerability. Many traders mistakenly believe that skill alone protects them from loss. Livermore understood that skill is only half the equation. The other half is the disciplined management of self after success. He also learned to embrace humility after contraction. Reducing size was not failure, it was wisdom. The market doesn't care how big your ego is. It only rewards alignment, and alignment requires mental and emotional equilibrium. Another critical aspect was understanding the impermanence of size. Livermore accepted that his ability to carry capital fluctuated. Growth wasn't linear. Capacity expanded and contracted with his discipline and emotional state. To scale safely, he treated size as a variable, not a promotion. This flexibility allowed him to survive where others, rigid and arrogant, would have failed. Every time he contracted, he reinforced the principle that markets are mirrors. They reflect patience, humility, and discipline back to the trader in real time. Misalignment is punished immediately. This insight became a cornerstone of his approach. Master yourself, and the market follows. Let ego lead, and it will cut you down. Finally, Livermore understood the cruel irony of scale. The more you succeed, the more dangerous it becomes to assume you are untouchable. Contraction is not retreat, it is preservation. It is preparation. It is a conscious choice to prioritize the long game over short-term thrill. And here is the pivotal realization. The trader who can expand, contract, and recalibrate repeatedly without letting ego dictate decisions is the trader who survives at scale. Most traders never learn this. They chase growth relentlessly, ignoring the subtle signals of internal overextension, and the market punishes them harshly. At the deepest level, scaling capital is not about charts, indicators, or strategies. It is an identity process. Jesse Livermore understood this better than anyone. The market doesn't ask what you want, it asks who you are under pressure. Every increase in size, every expansion of risk, every exposure tests patience, humility, and honesty. Your capital will only ever grow as far as your self-governance allows. Everything else is temporary. Livermore's legacy isn't measured in profits or headlines. It's measured in mastery over self. He discovered repeatedly that when ego led, accounts collapsed. When discipline led, capital followed. Systems, indicators, and advice are secondary. The primary determinant of success is whether you can remain aligned under stress, whether you can enforce your rules without compromise, whether you can stay detached from outcomes while executing flawlessly. Self-mastery is not a one-time achievement. It is a continuous journey. Livermore treated every trade as a mirror, reflecting his current capacity. The market is ruthless in revealing gaps between who we think we are and who we truly are. Scaling capital forces that mirror to show up in high definition. There is no hiding. There is no short-term illusion of skill. There is only the disciplined response, trade after trade, exposure after exposure. Identity must evolve alongside capital. Livermore recognized that most traders fail not because of strategy, but because their self-concept lags behind their account balance. The mind resists unfamiliar responsibility. The nervous system tightens. Rules are bent. Decisions are rushed. Losses, even small ones, feel catastrophic. Until identity catches up, scaling is impossible. And yet, scaling is possible. Step by step, exposure by exposure, the trader who cultivates self-awareness, emotional literacy, and disciplined behavior can expand capacity. Livermore treated each phase of growth as both a test and an opportunity. Each contraction, each restraint, each deliberate pause strengthened his internal architecture. The market then became a natural extension of his disciplined self, rather than a source of stress or ego gratification. This is why the truly great traders are not defined by their wins. They are defined by how consistently they maintain composure, clarity, and alignment when it matters most. Profits are a side effect. Mastery is the objective. Livermore lived this principle, and it is why his teachings remain timeless. The ultimate lesson is that trading at scale is a reflection of the inner game. If your mind wavers, your account wavers. If your identity is fragmented, your results fracture. If your self-mastery is strong, capital follows naturally. This is why Livermore's approach transcends market conditions, instruments, and eras. It is a blueprint for the human condition under risk. So, as you reflect on your own trading journey, ask yourself, are you scaling your capital or your identity? Are you building systems to hide from yourself or to reveal your true capacity? Are you chasing wins or cultivating mastery? The answers will determine whether your growth is sustainable or temporary. If this message reshapes the way you approach your trades, then act now. Subscribe, like, share, and comment below where you're watching from and what time it is. Take a moment to internalize that scaling is not about money alone. It is about who you are becoming in the process. And that is the real secret Jesse Livermore revealed, hidden not in the market, but in the mind. This is where legacy begins, not in accounts, not in numbers, in the disciplined expansion of self, the courage to face internal limits, and the wisdom to grow responsibly. Capital follows the trader who has mastered themselves, and mastery, above all, is the ultimate reward.